It is not a secret that home prices are blowing through the roof, making housing unaffordable. The situation is even worse if you factor in the rising interest rates. The latest studies show that home affordability is at the lowest level since the 1980s. In less than 2 years, United States home buyers lost half of their home purchase power just due to the interest rates climbing from 3% to almost 8%. Situation is even more critical here in the Bay Area. While the median home sale price in the U.S. is $410,000, here in Santa Clara and San Mateo counties, the median home sale price is roughly 4 times higher, at $1,580,000. Compare that with the level of real income in the area. The median Bay Area household income is only twice the national average. With home prices 4 times higher than nationwide average, and the income levels at only 2 times higher than national average, how can people afford to live here? Is it too late to buy a home here in the Bay Area? Will Bay Area home prices continue to grow? Is it wise to put your money in the real estate here? What do you think? Put your thoughts in the comments. Let's check how the housing market is doing now. The home prices were consistently growing since the beginning of 2023. Compared to January, the median home sale price in Santa Clara and San Mateo counties grew by 18.8%. The prices are now 3.6% higher than just a month ago in September, and by 10.9% compared to October of last year. October median home sale price was just 4% below the all-time high level reached in April of 2022. This meteoric growth of home values occurred while the mortgage interest rates were at the highest level since the year 2000. According to Freddie Mac, in a little over 2 years, the mortgage rates grew from the low of 2.77% to high of 7.79%, increasing the monthly payment by 43%, assuming identical loan amounts. What prevented the prices from collapsing was the shortage of inventory. The number of homes available for sale in October fell by more than 20% compared to the same time of last year. This drop occurred after many years of housing availability declines. Consider that there were 2,100 homes available for sale last month, while back during the summer of 2008, there were more than 12,000 homes in the market in our area. The chronic shortage of inventory is amplified by the heightened demand. Major employers want to bring workers back to the office. We encountered many buyers looking for homes within a reasonable commuting distance from their job locations. High-tech layoffs were not severe enough to dampen this demand for living space. The median time to sell a home declined from 14 days a year ago to just 10 days. It means that half of the homes sold in October were on the market for only 10 days or less. The economic situation is very fluid, and housing market conditions may shift really rapidly. Just this week, we received the first indicators that Federal Reserve's effort to slow the economy and to combat inflation are working. The unemployment rate started to inch up, reaching 3.9% in October. 150,000 jobs were created last month instead of the expected 170,000 jobs. With just these little hints of the upcoming recession, the mortgage market immediately reacted, and the rates dropped by 0.5%, down to the level not seen since September. There is a chance that the interest rates peaked already and are starting to trend downward. What do you think will be happening with the housing market when mortgage rates will decline below 7% or even 6%? First of all, we expect that the number of homes available for sale will continue to be well below the level of the buyer's demand. Many homeowners who still have their mortgages at 3% or even lower rates will continue to hold on to their homes even if it would be a better fit for them to move. Some of these homeowners will get creative and will build additions to their homes or ADUs in order to accommodate their needs instead of selling their homes. Others will just squeeze their lifestyle into their available space. But they will not move up or downsize as needed. They will prioritize keeping their low interest rate loans. Second, As interest rates decline, home buyers will be able to afford higher prices while maintaining the same monthly payments. It inevitably will lead to increased competition for the available homes and most likely another price spike similar to what we experienced in the first half of 2021 or during the spring of 2022. To summarize, the Bay Area is still an attractive place to buy a home, but it is not a get-rich-fast type of a deal. Bay Area is an equity market with limitless potential due to the lack of space for new housing developments and due to the strong economic engine creating hundreds of thousands of high-paying jobs. Underappreciated cities were growing at much higher pace than well-established areas. Think about Palo Alto, Los Altos, and Menlo Park versus East Palo Alto, Union City, and Newark. Check my video about the different rate of home value appreciation around the Bay Area. Link is in the corner. Only you can decide when it is the right time for you to buy a home, either a place to live in for yourself or an investment. You have to plan to hold on to it for a long term for the values to grow and to build real wealth. Your kids and grandkids will be grateful to you for that. This is Michael Talis with the Talis team. With major developments happening daily, if not hourly, it is critical to monitor and report on all the latest trends in the real estate industry. This is exactly what I will be doing. If you found this video useful, subscribe to our channel, support us by clicking on the like button, and please share this video with your friends who may also benefit from it. Till next time.